guys, just going over the example we did in class this week. Now, before we begin the balance sheet, the first thing we need to do is to identify what are our assets, what are our liabilities, and what are our capital. Now let's start with the accounts that we open in this question. So on May 1st, Nebelit started a business and deposited $60,000 into a bank account open especially for J. Nebelit Enterprises Limited. So when we analyze this, we see right away that Nebelit has taken $60,000 cash of his own money and put into a bank account. So we have to account for this cash. So we create an account called bank. Okay. Now, because Nebelit put his money into the company, the company now owes him that $60,000, and that's called capital or equity. So he can now withdraw $60,000 up to $60,000 from the company at some point in time. So let's create an account for J. Nebelit as capital. Alright, so on the second transaction, let's see what accounts do we have to open. Well, Nebelit buys a small shop for $30,000 paying by check. So because it paid by check, that means it came from the bank. Therefore, there's no account to be opened for this transaction here. This party transaction, sorry. But he bought a small shop. So therefore, we have to open an account for the shop. Because the shop now becomes an asset to the company. They exchange $30,000 in cash for a shop that worth $30,000. Now, the third transaction, Nebelit buys some goods for $77,000 from A. Marshall and agrees to pay for them sometime within the next 2 weeks. So he's bought goods, but he's not paid for the goods. So we have to create two accounts, or open two accounts to deal with this transaction. Now we'll call the account for goods stock. It can be called inventory as well. Alright, and then because he has not paid Marshall, he now has a liability of $7,000 to Marshall. So Marshall has extended credit to him, so let's call this a creditor's account. Creditor's account. Alright. Now on the 10th, the fourth transaction, goods were sold to J. Riley costing $600. Now Riley is going to pay the money later, but he's giving the goods now. So this affects two accounts. The first account affects you're taking goods out of stock, so therefore your stock goes down, but we already have an account for stock, so we don't have to create an account for that part of the transaction. However, Riley has taken it on credit, so now he's indebted to us for the $600, so we're going to create an account here called debitors. Alright, now the fifth transaction, goods costing $400 were sold to R. Watkins for the same amount. Watkins paid for them immediately by check. Well, we have an account already for the goods. We're just going to take away the $400 from the goods, and then Watkins paid for them immediately by check. That means it's going into our bank, so we don't have to create any accounts for this transaction. Let's see the sixth transaction. May 15th, Nebelit pays a check for $3,000 to A. Marshall in part payment of the amount owing. Now we have an account for checks, which is our bank account, and we already have an account for the liabilities that we owe Marshall, which is creditors, and therefore we have to create no new account. We just have to deal with the transaction. On the 31st of May, the final transaction, J. Riley, who owed J. Nebelit Enterprises $600, makes a payment of $200 by check. Again, we have an account for Riley, which is we have it under debitors, and we've also have an account to deal with the checks, which is the bank account. So we don't have to open any more accounts. So now we have our accounts for these transactions. We have the bank account, we have the capital account for Nebelit, we have the shop, stock, creditors, and debitors. Alright, so now we'll proceed to do the calculations. for these transactions. Now remember, I told you we do not balance off the balance sheet every day or at every transaction, but we do that at the end of the month. But for simplicity, we're going to do it here by transaction. So the first transaction on May 1st, he deposited money into the bank. So right away we put the $60,000 in the bank, and then we also going to have to put some money here in capital, under capital, because this is the money that he can withdraw to his personal account from the company. On May 3rd, he buys a small shop. So he got an asset called shop. So we're going to put it worth $32,000, sorry. So we put in the value of the shop, and of course he used up some cash. So he exchanged $32,000 worth of cash for a physical entity, a shop, having value or monetary value of $32,000. So let's put the transaction here. So it's going to use the brackets to show that we're deducting cash. Alright, and he has no liabilities, and he still has not withdrawn anything from the company. So let's just do the calculation. So we have the shop worth $32,000, and now we have $28,000 left in cash on the bank. We owe no one, and he has withdrawn no money to his personal account from the company. Okay, so right away you see that if you add the 32,000 and the 28,000, it balances back, because it's going to equal 60,000, and we have 60,000 on this side of the equation. Now on the 6th of May 6th, he buys goods and he does it on credit. So the first thing, let's increase our stock. So our stock goes up by $7,000 worth of stock, but however he hasn't paid cash, so he now owes for the goods. So it's a liability, and it's going to come on the creditors. So we put creditors go up by $7,000. Alright, now on May 10th, goods are costing $600 were sold to J. Riley for the same amount. The money is to be paid later. So we are actually, Riley came and he took out $600 worth of stock and promised to pay us later. So therefore we have to deduct the amount of stock we have on hand. So we no longer have that $600 on hand. So we have to take it away from the $7,000. And he doesn't give us any money. So now he owes us money. He promises paying money later. So it's still an asset. So it's $600 that we will get paid later. Okay, so let's do the calculation here. So he has $32,000 worth of property. Then he has on hand $6,400 worth of stock. He's promised our accounts receivable of $600, and he still has $28,000 in cash. $28,000 in cash on the bank, and he still has not paid off his creditors, so, or paid back Marshall. So, and the $7,000 there in liabilities, and his capital still remains the same because he has not withdrawn any money to his personal account. Alright, now on May 13th, goods costing $400 were sold to R. Watkins, who paid for it by check. So on May 13th, we got some money coming in, we got some stock going out. So therefore it will affect stock. So we will subtract the money that went, the stock that went out, and we will add money to the bank, equivalent value to the bank. Alright, so on May 13th, we still have in our possession the shop. We now have $6,000 worth of stock on hand. Riley still owes us money. He hasn't paid anything yet, and now we have $28,400 in cash and we have not paid off any of our liabilities, so the liability still comes down, and we have not withdrawn any money from the company to our personal account, so therefore our capital is still the same. Now on May 15th, we decide we're going to pay off some of the money that we owe Marshall. So therefore, if we're paying off some money, that means we paid it by check here, because we write checks, and we paid $3,000. So that means we're taking out $3,000 out of the bank, and therefore we're going to pay some of our liabilities. So we're paying down the liabilities, so we've got to take away the $3,000 from the liabilities. Alright, so write that properly. Alright, so then let's do the calculation. So we still have $32,000 in stock, in the shop, and we have $6,000 of goods on hand, and Riley still has not paid us any money, so we're expecting our accounts receivable of $600. Now we only have $25,400 in the bank. Alright, let's write that properly again. That didn't come out so nicely. There we go. And we now only owe Marshall $4,000, and we still have not withdrawn any money into our personal account, so we have $60,000 in capital in the company. Now on the 31st of May 31st, we receive a check of $200 from J. Riley. So that means we're going to deduct the amount of money that Riley owes us, so we take away from his debt, and now we're going to add that money to the bank because he gave us a check for $200. Alright, so let's do the adjustments. Let's make the adjustments there. So at the end of business, close of business on May 31st, we have a property worth $32,000. We have stock on hand of $6,000, and we have accounts receivable of $400, and then we have at the bank $25,600 in cash, and we only owe $4,000 in liabilities, and we still have not withdrawn any money from the company to our personal account, so we still have $60,000 in capital. That's in the business. Alright, so at the close of business, or we close the books off on the 31st of May, this is what we have on the balance sheet. So they will add back up to 64. This will add up, if you add it up, to 64,000, and this would also add up to 64,000. Alright, now in the next video I will show you how to write the simple balance sheet as a horizontal method, vertical method, and then a more detailed balance sheet.